Hi everyone, it's Grant Abbott speaking, and welcome to this little session on simple partnerships. I'm going to go short and sweet and fast on this one. Although I call it a simple, it's to delineate it between this and obviously our business partnership document, which is sitting up in the business and commercial area in our site, which is primarily for true like accounting, legal, true business partners where salary and wages and obviously also vacation, those sort of things are integrated into that partnership. Whereas a simple partnership is anything but simple. So it's not like a one-pager. This is an enterprise level document. But more importantly, it can be perfect for just mum and dads who might be operating as tenants in common, or brothers or sisters operating as tenants in common. So to put down and set down the not the boundaries, but the actual interest both parties have, the relationship they have, so that it really does turn into an arm's length partnership. But it goes a little bit further than that, and when we look at it, there's a number of instances when obviously partnerships do apply, and it's really when we get down to it, we can have a meeting of minds. So where you do have two or more parties that get together and enter into an undertaking, and it could be a sophisticated business or tenants in common or a joint venture, getting that structure right is important. So typically, as accountants and lawyers, we tend to go through on a go-to basis. We'll set up a unit trust or a company between the parties, and a partnership could be 10 or 20, 30 parties. But sometimes it doesn't make sense to use unit trusts or companies. For example, if we've got a discretionary trust and a self-managed super fund looking to enter into a property development or just undertaking together, provided, of course, that all the self-managed super fund laws are correct, we can't use a unit trust or a company because they would both be classified as related trusts and companies. Now, of course, we could use a 1322C trust or company, but then again, that's got some limitations. For example, with the 1322C trust, we can't invest in other entities such as shares or managed funds. We can't invest in ETFs. A lot of things we're limited. We're not allowed to borrow, obviously, in that respect as well. So the amount of grace that we're given with those is very limited. Whereas with a partnership, we're really wide open. So a discretionary trust and self-managed super fund could have a partnership that's investing in shares and managed funds and ETFs, and there's nothing wrong with that. So again, that's not a breach of the in-house assets test. It's not a breach of the rules. And so effectively from that perspective, we've just got to be mindful of how that relationship operates, which is the essence of what a simple partnership is. And I'll take you through really basic tenants in common, but when I go through that, I'll explain on how it can be used for JVs. So I just want to take you through the basics, then hit you over the head with a couple of advanced uses, and then show you what the document looks like. Now, partnerships are generally less common due to asset protections. Effectively, if the partnership is sued, then all partners are jointly and severally liable. So it's not the sort of entity that you want to undertake in terms of a risky venture. The old days are since changed now, where accountants and lawyers used to have to operate through partnerships. Obviously saw huge amounts of asset protection there, where assets were put in wives' names or in trusts if it was possible, to give some protection in case that partnership was sued. The classic one out of everything, if you remember way back in 2007, it was just a little bit before the GFC. In fact, I think it might have even been before that, with the Enron blow up. So someone might remember what the time was, but Arthur Andersen was a worldwide partnership, and they had very big offices here. In fact, I was very close, instead of going to KPMG, working for Arthur Andersen. but effectively I chose KPMG. However, they're very smart, some great people work there. But unfortunately, there was a legal action taken by the US government, which ultimately was found to be the Supreme Court knocked it out 9-0. But effectively, the action taken by the US government would have seen each and every partner effectively go bankrupt or attacked. And unfortunately, because it wasn't a localized partnership compared to, for example, most of the accounting firms, it was a worldwide partnership where everyone took the worldwide profits, but also all were jointly and severally liable. And if you go back and have a look at the history there, the government announced the decision to take action against Arthur Andersen Worldwide Partnership, and effectively the next day it was closed down. And so suddenly everyone who worked for Arthur Andersen was out of a job. So that's the only problem that we do have partnerships when they're jointly and severally liable. So we've got to be very careful. They're generally not for businesses because of the risk inherent in there. The assets are on the line, but the other side of the equation is they're great for tax losses flowing. So if we're in an entity, and probably not startups, but certainly if you and I wanted to go into a property, negatively gear the property, then the good thing about it is we both put our capital in, we work out our percentages that we're entitled to each other. There may be borrowings in there, and if the borrowings are in excess of, or the interest costs are in excess of the income coming in, and obviously we've got depreciation, capital allowances, then they all flow through compared to a company unit trust where they get locked up. So there is good and there's also bad, but that's something that's just to be explained to the clients. But the good old partnership works really well for many cases. So don't just jump straight into a unit trust or company, particularly where we're dealing with self-managed super funds. Well, I still love the 1322C trust. But in the long run, particularly if we're doing business, real property, etc., the partnership is a great little get together. So if we have a look at it, the first partnership agreement that we did build and up on the site and has been there for a long time is a true partnership agreement where you've got business partners, as I said before. So that's not my preference. Like if you and I were going into business together, I'd definitely not do a partnership. I'd probably use a company, etc. But if I was trying to involve my SMSF in the whole equation, I may well use a partnership, and a partnership not of individuals, but a partnership of trusts, companies, and also SMSFs. So that's taking it to the next level. Traditionally, we've always thought of partners as just being individuals, but we can have partners of entities, and I think that's pretty important. As I said before, particularly when it comes down to family law, estate planning law, etc., we need to look, and clients need to have a look. In Australia, essentially, wherever you buy a property as a husband and wife, I shouldn't say that, as a couple, and whether it's de facto or you're married, what happens there, it's treated as being joint tenancies. So that on the death of one, so it's automatically treated as a joint tenancy unless there's a box ticked for it to be tenant in common. So again, with that one, we need to sit down and work out exactly how it plays out, because if we've got joint, then joint is joint. So that there'd be an equal split in terms of any tax losses arising out of that property. Likewise, equal split of the underlying relevant income. So compare that to tenants in common, which you might have, for example, a 10% interest versus 90%. So, for example, if one is a high income earner, then if there's losses coming from that partnership, it's best to load up as much as possible to them. Now, that tenants in common is an interest, and there's a number of legal cases around that, so that a piece of property can be sliced and diced. If you have a look at places like Domicom, etc., anyone, you can chop up a piece of property into separate entitlements. Classic one is, of course, strata title, which is obviously airspace. So tenants in common is a little bit different because on death, obviously that part doesn't go to the other party. So look, having joint tenancies, we've got families and blended families may not work out. It might be better to put in place a tenants in common. And if you do a tenants in common, then it really needs to be evidenced by a legal partnership. And, hat tip to John Gowing, who's been pressing me on this for quite some time. But anyway, it's out and about now. However, as I said before, the simple partnership's anything but simple because you can have, obviously, companies, trusts and SMSFs doing it. So I've come up with a couple of little advanced uses, and this is by no means, no stretch of the imagination is it limited to this. Really, at the end of the day, I'll just give you the parameters in which to play the game. But at the end of the day, there's going to be numerous instances where we might go, I prefer to call it a JV, but again, it's just a simple partnership, but a joint venture is just a partnership at heart. So we can do JVs between arm's length and non-arm's length parties. So for example, here I've got a discretionary trust and is in a partnership with an SMSF to acquire property or develop property. So this is pretty keen. In fact, the Commissioner's Guidelines on Property Development, which I considered in detail and is up on our strategy centre, essentially there we went through quite a long elements on JVs. And in fact, at the end of the day, JVs are certainly preferred from the Commissioner's perspective rather than 1322C trusts, etc. So certainly that's the place that we want to pay. One of the ones, though, is, for example, where we do have a JV, which really, if there's property, so there's different ways of working on this. For example, you may have a property which is owned by the SMSF, and then on top of that, we're building sheds or farms or whatever, and that might be funded by the discretionary trust. Alternative, it could be the other way around, that the property might be in the discretionary trust or family company, and then the SMSF is going to commit funds in order to do the development of the properties. And then obviously needs to, at the end of the day, have an agreement as to what happens to those properties and the realisation of any profits from there. So either one can be good, works really well. But again, if it's just two discretionary trusts between a couple of brothers, it's really not a big issue. But once we get the SMSF, obviously we've then got to look down, the sole purpose test, arm's length rules, acquisition of interest, section 66. So it's very hard to transfer partial interest of residential property from related parties. Whereas if it was business real property, then there's no issue whatsoever. Listed shares, absolutely. We've also got to watch out in terms of borrowing prima facie. We can do an LRBA. So you can see down the next one. And I'm going to go over and have a look at a little bit of a case study in a second about a JV of LRBAs, related party loans, where SMSFs are investing in quite a significant property. So it's easy to do under our system, but it's extremely effective. So I'll look at that in a second. Let's just do one thing at a time. However, we've got an SMSF and a discretionary trust, and they're entering into whatever they want. Even if it's just to go and buy a commercial property, the issue that we are going to have is, unless we've got an LRBA, again, which is going to be our higher example in a second, then if the discretionary trust borrows the money to invest in that related party property or that business real property, then we've just got to be careful that the lender, who will obviously seeking a charge or a mortgage over that property, needs to be able to obviously just charge or mortgage only that part which is owned by the discretionary trust, not that part that's owned by the SMSF, as most banks want to charge the whole of the asset. That can then throw you into a problem with SIS regulation 1314. But by no stretch of the imagination should we ever give up. And I'm of the ilk and the view that when a client comes to you with a particular issue, that at the end of the day, there's always a solution to their problems. The hard thing is when they've already done something and then you're looking for a solution after that. That's where the concerns are. So ideally, what we're looking at doing there is we're ensuring that if you want to come to myself or Tony at Abbott-Family, we've done at least $1 billion in transactions in terms of advice work over the last 5 years using SMSFs and property. That in short, when we have a look at that, there's different tools that we can use. And the JV is certainly up there as one of my favourite tools. Obviously, the best is the superannuation unrelated investment trust if they're unrelated properties. But once we go in and the client wants to have control through different entities that they control, then the JV is really up there as opposed to 1322C. So we've got down the bottom one, we've got 2 SMSFs into a joint arrangement to buy a property, both SMSFs owned by the brothers. The SMSFs have a small amount of capital, but the brothers have capacity to do a related party loan. So that's, again, we'd use a simple partnership, although at that stage, it's obviously going to be a big ticket. So if we want to do that, we could jump on the LIghtYear Docs site and look for related party loans with property. So we need to, one is that work out the partnership agreement. So let's say it's a $3 million piece of property. Each SMSF, it depends on what they're doing, is putting in $1.5 million. So they're going to go equal parties. They're both brothers. They're both putting in $500,000 each, which is the SMSF has got that $500,000 plus some non-concessional contributions which are able to go in to each of the funds. And then the remainder or the remaining $1 million will be treated as a related party loan. And then over time, once the non-concessional capacity comes back on, there'll be a loan forgiveness, which again, you'll find that in our business and commercial transactions. That loan forgiveness will be equivalent to a contribution made into the system. So over a period of time, maybe 10 or 15 years, the whole loans could actually be paid down. So it's a good way of transferring value into the self-managed super fund. So it's easy to do on the LIghtYear Docs side. It's our related party loan agreement. I'll show you where to get it. And then essentially it accords with PCG 2015/6. So in that instance, we could have 2 LRBAs, but because we're investing directly in property, then our LVR is 70%. As opposed to if we try to do this through a 1322C trust, you can't have a borrowing in the trust itself. You have to have the borrowing down at the unit holder level. And the danger about that one is first, the PCG 2015/6 doesn't apply to unlisted units. And as a consequence of that, you've got to find a commercial lender who would actually lend to those, which is few and far between. So we tend not to use that. So JV is better. And even if we did say, look, we'll stick to the LVRs and try to fudge our way through that, then the LVR anyway for units is 50%. So the direct link in is a far better way. So we could use the related party loan agreement, which obviously the first part of it does SMSF trustee minutes to enter into the related party loan and the acquisition of the relevant property, establishment of the SMSF Bear Trust, the Bear trustee minutes to enter into the transaction, obviously, which is going to be the acquisition of the property, because the legal title obviously resides inside the Bear trustee. And then, although I did see, it's quite interesting, I did see generally the loan is by the SMSF, but I did see a ruling from the Commissioner just this, I think it was in November 2019, or in fact, it might have even been just a few months ago. 2020 has been a shocker, I think, for everyone, that the loan could actually be the trustee of the Bear Trust, which is interesting. So the loan could be the trustee of the bare trust. Whether that helps in the lending criteria for the bank, look, I'm not sure. But then again, interesting. It was an interesting ruling that came out. So obviously we did a related party loan agreement, which must be secured by a mortgage deed, which comes out of PCG 2015/6. And then we do our simple partnership agreements. And effectively it goes like that. So let's just go up and have a look. I've done a pre-prepared agreements here. So you'll be able to find up here, I've got one I did before. I obviously set up the simple partnership agreement. I'll take you here. You'll find the simple partnership agreement when I go into the document categories is obviously going to be in business and commercial agreements. So when I go down here, and we're starting to build up quite a sizable amount of agreements here. While I'm here, I might just give you a bit of an overview on what they are and more importantly, what I've got coming. So a couple of weeks ago, we did the farm lease agreement, which also correlated with, you can see we've got a commercial property lease there as well. I would put a residential lease up at some stage, but you know, these are the residential leases are pretty easy to get from most offices. So, you know, public affairs office, etc. So I'll do that. We've got the simple partnership agreement, which dealt with the annuity contract, which is the provision of an income stream, equipment and motor vehicle lease agreements. That's where we're using associated leases for FBT. Again, it's not too bad to have a discretionary trust for asset protection to hold to actually hold the motor vehicle and then lease it to our individuals concerned. SMSF you can do, you can't lease it directly to an individual, although you probably can do, because I think section 65 will apply because you're not providing finance. If it's a true hire purchase, you can do that. We've got buy-sell options, deed of loan forgiveness. Remember I talked about that, where there's a underlying borrowing under the LRBA that we can do a deed of loan forgiveness and that will equate to a contribution. Rental reduction agreement, obviously Div 7A loan agreement, all purposes loan agreements, a deed of gift. We've also got commercial property leases, service agreement, which is good for contractors, etc. And there's that business partnership agreement as well, mortgage deed, SMSF loan agreement, personal guarantee, and NDAs and confidentiality. So we're building up a really good stock of documents in here, which at some stage will include employment agreements. So I've got one of those. The next big one that I'm going to be releasing in this section, which will probably be out in a few weeks, will be a license agreement. Been working pretty closely with my good mate Tim, and he obviously would like to see a license agreement for IP, which might be held in one entity, and there's then obviously a sign. Well, it's not a sign because a sign actually means a transfer, capital gains, and potentially stamp duty. It's just simply a license of that property. If it's a perpetual license, then effectively has the same effect of going over. So that license agreement will be coming up very shortly. I'm doing quite a bit of work in Abbott-Family for that. So I've got the simple partnership agreement. I just have to go in and set it up. So what I've done previously, as you can see, I did one this morning. Just click on there. You can see I did one there at 10:05. I'm in Adelaide, so it's currently 10:54 at the moment. So I'll just reset this. This is a very simple one, and I'll just go through and I'll talk about what happens with JVs as well. So you can see here, I'm using Chrome. If you're using Chrome, Edge, we move from Chrome to Edge, and then Edge has its own cookie. So every time they change cookies, because this is actually a site that there's a pop out of the site, and that's the Hot Docs platform. Effectively, what happens there is just if you go on there, you'll find that there's a couple of things just to calibrate for Chrome, and you can use this system pretty well. We will be going to a new system that will be launched. It looks as though it's in probably the 1st of April or mid-April. We'll be looking at launching a brand new system, which will take this up to even a higher notch. So look, I love where it is at the moment, and you'll see next week when we bring the moat and the castle out, it's going to blow your mind. If you think the moat was strong, you wait until you see the moat and a castle. So it's definitely going to revolutionise the way that we deal with things to make things simpler. And in that, we've got common addresses. So it even saves us the problems of continuously having to write in addresses. So here I've got just the name of the partnership. So I've got the Smith Tenants in Common. So this is between John and Sally, husband and second wife. They're buying a property, very simple one, for $800,000. And they are creating a partnership agreement for it. So the partnership agreement starts on the 29th of October, based in New South Wales. We've got a couple of purposes there. One is to the partnership, although it's buying one, is to invest, develop and renovate property. Secondly, to look for low-cost property right for renovation. And again, you can just put in as there is then to market the properties for Airbnb purposes. So you can actually run an Airbnb business through this. It's the same thing as Airbnb. It'd be interesting. I've never thought of that, but there's nothing wrong with an SMSF running an Airbnb business coming through. So it's not a bad idea to probably come hit a bit of a gold mine there. So not a bad idea to think about how that may apply, because when we get down to the next partners, I've got 2 partners, and you can go obviously 10 partners, I think is the maximum. The first partner I've got John. You can see there's an individual, but if we're doing a JV, and as I said, the difference is if you and I are doing as individuals, I call that a partnership. But if there's a couple of entities, then we call it a joint venture. And joint venture is usually just 1 or 2 parties. So you could put in there, for example, an SMSF or a trust, a company. Remember those ones I had a look at a little while ago? You just choose their details and put those in. So I've just got John Smith. The key there is obviously the capital contribution. I've got John there who's put in 400. He's got his spouse, Sally. So she's just in there, second wife. She's put in 200,000. So sorry, it was not an $800,000 property. It was a, well, actually, we'll just change that. So I made a mistake. I thought it was 600. Let's go down and we'll make it the 800,000 property that we discussed. So all I have to do is just change that to $600,000 and then we're off and running. Partnership address, it could be where they live, or it could alternatively be the property. So it's just essentially where the operations are. So let's go and finish and have a look at what the document looks like. I use the Abbott-Family logo, but you can use obviously your logo as well. So we'll pull that up and let's have a look at the document itself. Okay, so we've got a simple partnership here, a simple partnership agreement. This is the Smith Tenants in Common partnership. I might actually change, I don't know, I'll get your feedback again. You know, once we get it up on the system, it's very easy to make changes. So if someone wants to, I can easily do a click box so we can change it from a simple partnership to a joint venture if need be. So if you'd like to give me feedback on that when you come around to doing it. So when we have a look at it, the agreement, again, it's an enterprise partnership level. So nothing's simple: name and purpose, place of operations terms, the capital contribution, the partnership bank P&L, how it's to be split, the income year, the partnership book of accounts, obligations of the parties, withdrawal, death of the partner and partnership continuation. So that's really relevant to divorce and also the event of death, modifications to the agreement, notice termination, indemnification for the partners. The agreement obviously can be severed in part and then still maintain the guts of the agreement. Entire agreement, applicable law, and obviously arbitration if there's a fight as to the partnership. So we just go through the sign-off from Abbott-Family, and I think it's pretty important because I think people are getting confused. All of our documents at Abbott-Family, on the LIghtYear Docs platform, have been signed off by Abbott-Family. So what does that mean? It means that effectively the document does what it says it's supposed to do. So this is a joint venture document or a simple partnership document. Covers all the legalities around that. SMSF deed is obviously an SMSF. From that perspective, generally the next question is, well, hold on, if I do this agreement, will I be providing legal advice? We've got plenty of letters from Tony, etc., having a review of the Legal Professions Act, the Uniform Legal Professions Act of 2014, that in essence, the taking of data capture or going through an interview with a client, because in the end of the day, you're really just transposing the client's details, the amount of the capital contribution, and more importantly, what the partnership operations are. So you're not getting down into the detail as to, what's the severability of the agreement or how it's to apply here and there. It's already done for you. So you can't make those changes. If you went in and tried to draft it up yourself, which many people do when they come around to doing minutes, etc., that's where you start to blur the lines around Legal Professions Act. So the Smith Tenants in Common Partnership, you've got the partnership agreement there. First partner, second partner, Sally Smith. A desire to conduct the partnership may include a tenants in common partnership, to invest, develop and renovate property, to look for low-cost property right for renovation, and obviously I've got a typo there, so I'd have to go back and relaunch to market the properties for Airbnb purposes. Principal place of operation should be at 5 Smith Street, commenced on the 29th. First partner, John, $600,000. So any losses, 3/4 will go to John, and obviously we've got there a quarter or 25% would go to Sally. We talk about the capital account there. So each partner's capital account is separate. So we've got here, if partners holding majority in capital decide the capital is or will be insufficient to continue the partnership, they may, by written notice, call for additional capital. Withdrawal, you can't withdraw capital. There's a whole lot. Again, this is enterprise partnership bank. P&L, net profit or loss of the partnership, be divided and borne in the same proportion as the capital contribution made by the partners. So again, this is a really nice little one to evidence a partnership, particularly for property, but also for a JV. So we go through the income year, a partnership books account, all the operations of the partners, what they're able to do, they're able to give charges, etc., provided it fits within the law. What happens on the withdrawal or the death of the parties? I've put in a lot more there: permanent physical, mental disability, retirement, etc. So at any point in time, they can fold out of the partnership, which is, it's easy to get into partnerships, but we want to make sure that we do. And the other partner then has the ability to obviously has the first dibs on getting that partnership interest. And it'll depend, that's even against the executor of the estate, if there's a death there. Termination between the two or the government entity or courts, indemnification, severability, entire agreement, so on and so forth. Then we sign it by John Smith, get a witness, and also Sally Smith. And that's effectively our partnership agreement. So while I'm here, I might as well go in and I'll do a JV between discretionary trust. So I just simple, up comes the simple partnership agreement. So I'm going to start the document and I'm going to look for the folder. So I put everything in the Abbott test, start this agreement. So you've already seen this, we just went through this. I'm going to crack it on right from the start. So the first thing is I've got to need to know my name. So I'll call it the Smith Family JV. JV. So as soon as you're going in, and it's pretty important also, if this is a big ticket item, where there's potential lot of downside or there's a lot of money in there, for example, it's a $5 million partnership, you may well want to contact us at Abbott-Family Lawyers. You can draft up the guts of the agreement and charge a client a fee for that. But at the end of the day, if you want, which is typically our case, you can then pass it over to us to finesse it, particularly if there's some additional clauses that you may want to put in there, and then we'll just charge you a flat fee for it. But the beautiful thing about that is if we finesse it and charge a flat fee for it, then effectively we open up a client folder, and it might only be, for example, we've done lost deeds before for $395. So we open up a client folder, we prepare it, but here we finesse it, that agreement that you've done, and then we charge a flat fee. But effectively that now means that document is being prepared by the legal firm Abbott-Family. So although you've had a lot of administrative work into preparing it, at the end of the day, you haven't prepared. It's actually come out of Abbott-Family. So you can do that with any document that's sitting on the system. So what's the full name of the partnership? So we'll call it the Smith Family Structures. Sorry about that. Property development. Actually, I'll do a joint. Sorry, joint venture. Okay, so when's it going to start? Let's start it from the 1st of November. So this is going to be executed. We'll start it from the 1st of November. And effectively, we'll just make this New South Wales. Now, partnerships, unlike trusts, don't need property to start off with. So let's go in and put in here. So sorry, because of I've got my a screen of the different size, so you can't see the whole of the thing. But anyway, oh gosh. So to develop property within Australia between related entities of the Smith family. So again, it doesn't hurt to actually say what you're doing right up front. Now you can put, I would orderly put in there marketing, doing this, doing that. So you can put, all the key components as to what the operations of that property development are is important. So I'd put those in there, but I'm not going to this time. So I'll just, what I'll do is I'll save the answers, and just a general guide on this system. I'll have two parties. So a general guide on the system is just to make sure that you do save along. So for example, I was building the first simple partnership this morning. Someone called me for like 10 or 15 minutes. And then when I went back and completed the document, obviously it timed out. So what we need to do is just be careful of that one. So I've confirmed it. I've got two partners. As I said, you can put up to 10. Now this one, I'm going to do a trust. So I've got the Smith Family Trust. So that's okay. The contribution they're putting in. Now, again, so the contribution will tell us what the percentage is of each party. So what we can do is we can put in, let's say, what we're doing is we're putting in $1 million. Now, sorry, $1 million. So if I did that, that means the trust is putting in $1 million, and effectively we're going to depend on what the SMSF are doing. Now that $1 million of capital contribution doesn't have to be all cash. It could be borrowings as well. Subject, again, remember that charging that I talked about if we've got an SMSF in there. But if it's just two discretionary trusts, then obviously you can just charge the property. So we've got the trustee being a company. So we'll just scroll down there. So it's a long scroll down. So we'll just call it, so this is the name of the Pty Limited. Put in the ACN. A registered address. As I said before, you're going to be very, very happy because we're just about to introduce a system whereby the addresses are stored and you can pull them down throughout the document. We've had quite a bit of development on that one. So that will be out very shortly, and I'll be showcasing it next week for the moat and the castle. So if you can get to anyone, that's definitely the one that you want to go to. So 2 directors, put in 2 there, and then we confirm. And then we've got John Smith, and we can put his brother, James Smith. So it could be James's SMSF, and it could be John's family trust. In fact, what I'll do is I'll change that to John's family trust, Sally Smith. And then I'll go to the next one. So the next partner, oops, sorry. So you can see what I've done. So I'll put here, this is the partnership address. Sydney, New South Wales, 2000. Oh, sorry. Unfortunately, I've got my screen, I'm just at the table, and I can't, I've got a Microsoft, it's damn hard to find. So I forgot here down the bottom, add a partner. Okay, so it's going to be an SMSF. So the Smith Family Super Fund. So Smith Family Super Fund. So capital contribution, again, 1 mil. And the fund trustee is a company. And so we'll just go down there. So we've got super nominees, Pty Limited, ACN. Same thing. Again, as you can see, it's going to be so much better once we get that 5 Smith Street. Sydney, New South Wales, 2000. And this one we'll just have the sole director. Remember how, although John and Sally could both be members, what I've done is just chosen one because John's got Sally's enduring power of attorney, if you saw the session yesterday. So just finish that. And then there you go, you've got a great little JV agreement. I'd certainly encourage you, well, I'll put this agreement, let me just download it. And let me download it. And I'm going to put it into, sorry, if I just put in here, I hope you don't mind me fussing around a little bit. But I want to make sure that you get a copy of this with the, you're going to get a copy of this with the recording that's coming out a little bit later today. So it's not November yet. Jumping the gun there. So October the 29th. So I'll just put sample SMSF and discretionary trust. Okay, so you get a copy of that as well. So have a look at it through your own time to see when you go through joint venture. The big one's going to obviously be what happens at the withdrawal, death of partnership and partnership continuation, and additional capital put into the partnership, what happens there. So have a good look through that. So the Smith family structures, property development joint venture between Smith nominees as trustee for the Smith Family Trust and then the Smith Family Superannuation Fund. Now, I would have, as I said before, rather than just doing one, I would have put in there, you know, to market property, to do this, to do this, to do this, so on and so forth. I think it was quite brainy actually when I came up with that Airbnb idea. We put in our capital contributions and then we go straight through stock standard. We go down to our signing pages and you can see there you've got Smith nominees. So I obviously didn't put the PTY Limited in there or this little quirk there. So I'll look at that. And then we've got John and Sally Smith and the same thing there, Smith Super Nominee. So let me follow up on that one. So Then there you've got a pretty good little, well, not pretty good, a very sophisticated joint venture agreement to look at. So let's go back to our slides, just wind up. If there's no further questions, I'll just go to the final one. As I said before, what we're looking at doing is next week is the Moat in the Castle, which will be really good. Next, I've got a short form Queensland EPOA. So the current Queensland EPOA splits financial and also health, which is important because you need that for advanced healthcare directives. Victorian EPOA, which is a short form, but I've got a longer form that's coming out next week. And so they'll be released next Thursday as well. So you'll find those in the Moat in the Castle. Victorian and New South Wales advanced healthcare directives will be released tomorrow. I know many of you have been waiting on them. I just had to get them right. They weren't exactly where I want. On the, actually not the 8th of November, it's the 18th of November this year. Abbott-Family, so Tony and I will be holding a 2-hour introduction to estate planning workshop. And that'll be a really, it's a great workshop because it goes through capital protected trusts, when to use a special disability trust, what are the basics around the wills. So I know a lot of the stuff that you guys are getting into, you need to get that confidence up of how, what they mean and how to build them. And look, I've seen some of the ones that come through our system, some of the testamentary trusts, and you guys are really starting to rock it. So the more that we get involved here and challenge ourselves, the stronger that we're going to get. Anyway, just final one, I'll just show you through what's coming up in the what's coming up in LIghtYear Docs. So our upcoming webinars, you can access all your past ones there as well. So next week, definitely we looked at that one yesterday. Simple partnerships we've got today. 5th of November, the launch of the Super Moat. Make sure you go there. That's absolutely crucial as well. Strategy webinar on the 10th of November, my top 5 SMSF strategies. And then we've got asset protection case studies on the 11th of November. 12th of November, family succession planning. 19th of November, LYD succession, successor directors, etc. So there's a lot of good stuff that's happening there. So just be mindful, and let's all work together. And if you've got any questions around JVs or simple partnerships, we're always there. Just send in a support email, support ticket. Alternatively, you can contact either myself or Tony. Anyway, it's Grant Abbott signing off.